Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. Today is March 30th, 2026. We're going to review last week's markets and talk about what's going on today. So, Wall Street reacts to Middle East conflict. Stocks ended a challenging week lower as investors' attention shifted from updates on ceasefire talks to concerns about economic impact of a protracted conflict. The Standard & Poor's S&P 500 index lost 2.12% last week, marking its fifth consecutive weekly loss, and putting the market benchmark on track for its largest monthly loss in 3.5 years. The S&P 500 ended Friday's session at 6,368.85 and is down now 7% for the year. The NASDAQ Composite Index fell 3.23%, closing Friday's session at 20,948.36, down about 10.5% year to date. The Dow Jones Industrial Average slid 0.90%, closing Friday's session at 45,166.64, down about 5.65% year to date. The MSCI EAFE index, which tracks developed overseas stock markets, ended the week flat, negative 0.05%. It's a challenging week. Friday's closing level for the S&P 500 marks a 7.4% drop from where it ended February. The index hasn't lost that much in a month since September 2022, when it lost 9.3%. There are just 2 trading days remaining in the month. That would be today and then tomorrow, and then we start April. The loss for March would also represent the S&P 500's biggest drop for the month since 2020, when the COVID-19 pandemic led to shutdowns across the country. The declines have come amid the U.S.-Israel war with Iran, which has contributed to market uncertainty and a surge in oil prices. This week, U.S. President Donald Trump announced delays for strikes on Iran's energy sector, but the U.S. has also been sending more troops to the Middle East. Data released on Friday by the University of Michigan showed the U.S. consumer sentiment this month reached its lowest level since December, while year-ahead inflation expectations had the largest one-month gain since April amid concerns about the ongoing Middle East conflict. Communication services has the largest weekly drop by sector, falling 7.2%, followed by a 3.5% decline in technology and a 2.1% slip in financials. Consumer discretionary, industrials, healthcare, and real estate also moved lower. Shares of Facebook, parent Meta Platforms, and Google, parent Alphabet, weighed on communication services as both were found liable by a jury for a 20-year-old woman's alleged addiction to their social media platforms. Meta's shares fell 11% on the week, while Alphabet's shares slid 8.9%. Micron Technology had the largest percentage drop of the week in the tech sector, falling 16% amid Nikkei Asia report that the company is in talks with Japan Display to acquire the LCD panel production plant in Japan. The report, which cited people familiar with the matter, said Micron could use the facility to assemble and test chips. So, sector spotlight. On the upside, however, energy jumped 6.2%, followed by a 4.2% rise in materials and a 2.9% advance in utilities. Consumer staples also edged up 1.2%. Some investors have turned to energy stocks during the volatility. At the close of trading, 19 energy stocks in the S&P 500 traded at their 52-week highs. Schlumberger and APA led the energy sector's gainers as crude oil futures continue to climb. SLB or Schlumberger rose 15%, while APA added 14%. Earnings reports are expected next week from companies including Nike, McCormick, and Conagra brands. The U.S. stock market will be closed on Friday for the Good Friday holiday. The government's March employment report, one of the most closely watched economic reports, will still be released that morning. So buying opportunities. The S&P 500, NASDAQ Composite, and Dow Jones Industrial Averages or indexes from a technical standpoint are all in oversold territory with the daily and weekly RSI, ADX, MACD, and full stochastic oscillators potentially marking a long-term buying opportunity. There are also high-quality companies with great cash flows selling at a discount as valuations have come down and are being repriced, representing potential long-term buying or rebalancing opportunities. So look for those. Talk to your financial professional or give us a call at Northbound Wealth Management. We can potentially help you with that. As a reminder, since World War II, there have been 37 U.S. equity market corrections of 10% or more, 13 of which have been bear market corrections, peak to trough declines of 20% or more. In fact, there have been 3 distinct bear market corrections in excess of 20% over the last 5 years alone, all of which are buying opportunities, in my opinion. Modeling out into the future upon the resolution of some of the matters and the resumption of non-worst case scenarios being priced in, the market should rip higher. And when it does, it likely will be very quick. A bit further down the road, I believe investors may celebrate not selling, holding certain positions, as well as the averaging in process, buying into lower price points during times where certain investors are most fearful. All right. So the S&P 500, the one-year trailing number is up around 14%. The NASDAQ is up around 20%. Dow Jones is up about 10%. And the MSCI EFA index overseas is up about 19. That's the one-year trailing number. So we're having a little bit of a pullback from where we were, all-time highs, just like 30, 60 days ago. To where we are today. So it's not out of the ordinary to have a pullback like this. It's normal, actually. 10-year Treasury rate is at 4.44%. And that's up about 11.84% from about 1 month ago, where we had a 3.97 print. Thank you, Y-Charts, for that information. Comments by Jerome Powell at Harvard University about the AI and future employment, as well as private credit. So I wanted to cover that. It's important. The Fed head is still out there talking, and it didn't get a lot of the headline attention because it's been buried under the Middle East conflict, but it's still important. Federal Reserve Chair Jerome Powell told his students at Harvard that he was optimistic about their long-term employment prospects despite the proliferation of AI. He said, quote, "There's no denying it's a challenging time to enter the labor market, but it may take patience and all that. But in the longer term, the economy is going to give you great opportunities." End quote. Powell said he did that. He communicated that during a talk with students on Monday, which is March 30th, according to Bloomberg. Powell said that while the U.S. economy was undergoing structural changes due to AI and other advances, it remained dynamic, whatever that means, I guess. Bloomberg noted that the unemployment rate for 20 to 24-year-olds was 7.4% after hitting over 9% last year. That's much higher than the broader unemployment rate of around 4.5%. Powell doesn't see private credit markets concerns posing systemic risk. So Federal Reserve Chair Powell told his students at Harvard that he didn't believe stress in the private credit markets posed a systemic risk, adding that banks were aware of their exposures. He said, quote, "We're looking for connections to the banking system and things that might result in contagion," end quote. We don't see that right now. What we see is a correction going on. It doesn't seem to have the makings of a broader systemic event. He actually reiterated that. So he also noted that private credit was a relatively small slice of the asset pool and that the Fed was watching it super carefully because that's a headline risk. That's actually something that's been out there in the media quite a bit, is the private credit space. Because there's illiquidity fears by a lot of the bears out there. Goldman Sachs, war-driven sell-off improves setup for U.S. stocks ahead of key earnings. I pulled this note because I thought it was relevant to the situation. This is Goldman Sachs, one of the leading investment banks in the country. After investors reduced exposure to U.S. equities last week, the distribution of near-term outcomes has improved, according to Goldman Sachs strategists. They said the first quarter earnings season in mid-April will be a key in providing clarity on the outlook of and the impact of the Middle East conflict. The team led by Ben Snyder expects the S&P 500 earnings to grow at a solid 12% this year, barring a severely prolonged disruption with AI investment presenting a key tailwind, Bloomberg reported. Outside of tech, the key question is the extent to which the elevated energy prices and supply chain disruption weigh on corporate profits, especially via margins. Given this, guidance and commentary are likely to garner more attention than actual results this year, the report added. Early Q1 reports have issued promising results, leading analysts to raise 2026 EPS or earnings per share estimates for most S&P 500 companies that have reported during the past month. The bank's U.S. equity market segment indicator is posting its lowest reading since August of last year, improving the near-term outlook. However, positioning at current levels still appears, quote, insufficient to drive the market higher without an improvement in the fundamental outlook, end quote, according to the report. So let me interpret that. The fundamental outlook has to be the Middle East conflict and oil prices. According to the TMC research, the stock market's decline since the Iran war started isn't surprising, but most market observers have been puzzled by the gradual, orderly slide in equities to date. The reason why is because they thought it would be worse than it actually is. And that's because the U.S. economy and the consumer here is resilient, and the oil markets here in the United States are a lot different than those in the Middle East quadrant over there. So we're not as impacted as much, given that we have plenty of it, actually, oversupply. All right. Key economic data. Monday, New York Fed President John Williams speaks. Tuesday, S&P Case-Shiller Home Price Index. That's an area that's kind of a black eye. I've talked about it quite a bit. In the housing market's just jammed up. Consumer confidence, job openings. Multiple Fed heads speak on Tuesday. Wednesday, retail sales, ADP employment report, PMI, EIA petroleum status report, and then other Fed heads talk. Thursday, weekly jobless claims, trade deficit, and EIA natural gas report, motor vehicle sales, and the Fed balance sheet, and then a couple more Fed heads talk. Friday, employment report, PMI services, which is Good Friday. All right, so tax tip of the week. IRS program helps seniors prepare taxes. The Internal Revenue Service offers a free file tool that provides online tax prep, direct deposit of refunds, and electronic filing choices. This tool can be helpful for taxpayers on a fixed budget, including seniors and retirees. Here are some things to know about the tool. IRS free file is available at irs.gov and features some of the biggest names in tax software. To use the tool, taxpayers can browse multiple offers. The eligibility standards for free file vary by tax partner, but are usually based on income, age, and state residency. Free file has the most common forms needed to file your taxes. Even if you have a unique tax situation, you may be able to use free file. Some free file products are available in Spanish. You can also search for credits and deductions in free file. Some providers in free file also offer state return preparation. You can use the lookup tool in free file to find the tax partner that might be appropriate for your state requirements. Taxpayers can access free file through their computers, smartphones, or tablets. The site is designed for mobile usage. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, we got a good show for you. Stay tuned for the next segment. Here's some good advice from Warren Buffett. He's passed along words of wisdom that later sounded like common sense you somehow forgot. I would tell investors, don't watch the market closely. That's what he said. He offered that insight in March 2016 when stock prices were under pressure due to concerns about China, oil prices, and global economic conditions. Fast forward to March 2026, and, quote, don't watch the market closely, end quote, has become something of a lifeline in the past few weeks. By the way, don't the concerns from March 2016 sound an awful lot like the concerns of March 2026? Managing emotions, how often does a 5% pullback turn into something more? Listen to Warren and don't watch the markets closely. So, since World War II, there have been 105 pullbacks in the S&P 500. 26 turned into a correction and 13 into bear markets. Will the number of corrections for the S&P 500 increase to 27 this year? Not sure. 63%, neither. Turns into a correction 25% and turns into a bear market 12%. So that's from Carson Investment Research 2026. And it's good food for thought. If you find yourself trapped in the stock market's news cycle, Warren would say it's time to take a break. Spring officially started on March 20th, so hopefully you'll be able to enjoy all that the new season has to offer sooner rather than later. Maybe get outside, do some yard work, and get out into the nice warm weather that's starting to move its way across the country in this spring season. All right, stay tuned for the next segment. Selling pressure intensifies as now nearly 300 of the S&P 500 names trade lower in 2026. So the S&P 500 has continued its downward trajectory in 2026, with the benchmark index now lower by roughly 7.5% year to date, reflecting broad-based weakness across U.S. equities. While losses have been widespread, a significant share of the decline has been driven by the so-called Mag 7 group of mega-cap tech names that collectively account for nearly one-third of the index weighting. On average, these stocks have fallen together about 15% this year, amplifying pressure on the broad market. However, the downturn's not limited to large-cap tech. Market breadth has deteriorated notably, with 288 of the index 500 constituents currently trading in negative territory for the year. Of those, 65 stocks have declined by 20% or more, while 21 have dropped at least 30%, underscoring the depth and persistence of the ongoing sell-off. Some of those company names in the Mag 7 that are down in 2026, Microsoft's down 25.7% year to date. Tesla's down about 20.6% year to date. Meta Platforms or Facebook's down 18.6% year to date. Alphabet's down, that's Google, that is, 12.9% year to date. Amazon is down about 12.3% year to date. Nvidia is down 10.8% year to date. And Apple is down 9.1% year to date. These declines ought to get you thinking, what changed? What really changed in this space to cause this decline? And is it overblown? And maybe it's time to sharpen some pencils, get some pens out, and start thinking about where one could actually pick up some exposure to these names. They've done very, very well over the years, and they're just in a down draft pullback, a correction that is. And most likely it's near term. And most likely people are going to rebalance into other names that might have some upside, or maybe those who didn't own some of these names might be allocating to them, or maybe just buying an index, which will support the valuations going forward. So try not to be nearsighted. Try to look out towards the end of the year into next year and think, my goodness, these things are beginning to look on sale. So anyway, food for thought on that end, but talk to your financial advisor and not advice. Stay tuned for the next segment. All right, so Goldman Sachs headline, war-driven sell-off improves setup for U.S. stocks ahead of key earnings. So after investors reduced exposure to U.S. equities last week, the distribution of near-term outcomes has improved, according to Goldman Sachs strategists. They said the first quarter earnings season in mid-April will be key to providing clarity on the outlook and the impact of the Middle East conflict. The team, led by Ben Snyder, expects the S&P 500 earnings to grow at a solid 12% this year, barring a severely prolonged disruption, with AI investment presenting a likely tailwind, Bloomberg reported. Outside of tech, the key question is the extent to which the elevated energy prices and supply chain disruptions weigh on corporate profits, especially via margins. Given this, guidance and commentary are likely to garner more attention than actual results this quarter, the report added. Early Q1 reports have issued promising results, leading analysts to raise 2026 EPS estimates for most S&P 500 companies that have reported during the past month. The bank's U.S. equity market sentiment indicator is posting its lowest reading since August of last year, improving the near-term outlook. However, positioning at current levels still appears insufficient to drive the market higher without an improvement in the fundamental outlook, according to the report. According to TMC Research, the stock market's decline since the Iran war started isn't surprising. but some market observers have been puzzled by the gradual, orderly slide in equities to date. And that's what I keep saying is this has to do with energy prices and an energy price spike. And if we can get some visibility into the trend of energy prices and futures contracts there, and then get some fundamental backdrop of resolution in the Middle East conflict, you're going to see the market really respond positively to that news, as there's going to be more clarity and visibility into the next 6 to 9 months of equity markets. Stay tuned for the next segment. All right, Nvidia valuations falls to S&P 500 parity for the first time in over a decade. So March 30th, 2026, as of this morning, Nvidia's forward price to earnings ratio has tumbled to match the broader S&P 500 for the first time in more than 10 years. According to a Goldman Sachs trading desk note circulated Monday, the chipmaker, which has dominated the artificial intelligence boom, now trades at par or a slight discount to the index on a forward PE basis, despite its outsized role in driving market growth. Goldman Sachs analysts highlighted a striking disconnect. Nvidia alone is expected to contribute about 21% of the S&P 500's total earnings growth in 2026, yet investors are no longer paying a premium for that growth. The valuation compression marks a significant shift for a stock that commanded substantial premiums during the AI infrastructure build-out of recent years. Nvidia shares surged as data centers raced to acquire its graphic processing units for training and deploying large language models. The development suggests that investors may be growing more cautious about the sustainability of AI-related spending or pricing in increased competition in the chip market. Market watchers will be closely monitoring whether the valuation reset represents a buying opportunity or signals broader concerns about the AI investment cycle's trajectory. And that source is from Bloomberg. And we're following NVIDIA as it is a core holding at Northbound Wealth Management. And we believe that the earnings that are coming up are going to be very important for the company. They're crushing it on earnings and doing a great job. And the market is not rewarding them for that at the moment, but that could easily change in the future. So we'll be tracking that for you.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.